Very good evening to all of you. Welcome to practical session number 20 for the year 2024 for demand supply trading methodology. Myself, Srujit Kakar, and today is Sunday, 26th of May 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk not all in the market, and also about the copyrights. So today's session is the practical application of demand supply methodology. That is what we do every weekend. So our demand supply methodology course used to be a paid course, but we have made it as an absolutely free course now. In case you have not gone through the course content, you can find the links in the description. The course is available in both the languages, English as well as in Hindi. So the links to the playlist are available in the description, which will help you understand the methodology theoretically. And whatever you're learning theoretically in these sessions, which I do every weekend, we apply the complete process, the complete methodology to some examples so that we can understand how to plan trades very mechanically, very rule based using demand supply. So for today's session, we don't have any trade which is pending for review. Whatever got triggered in the past has already been reviewed. So nothing is pending for the review. We can straight away start with our analysis for today. So starting with the analysis, whenever I talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video, and the title of that video is how to start trading. Now, during the session, if I talk about some documents or if I talk about some videos, the links are available in the description. So do not worry, where do I find these documents or where do I find these videos. Just go to the description section and you'll be able to find all the links available there to you. All right, so like I was saying, trading has to be mechanical and rule based, and why it should be mechanical rule based has been explained in the video. The title is how to start trading. Now you might have to go through the process that I've explained in that video maybe multiple times, but yes, there is no bypassing it. Eventually you'll have to go through it, so the sooner you start, the better it is going to be for you. Now, what happens is, yes, we do understand after watching that video that we need to be mechanical and rule based. But the challenge is when you're learning a new methodology, or even when you started learning trading as a fresher, it's not very easy to create a trade plan, because to create a trade plan, first you need to have good enough experience of that methodology, of that strategy. And only when you have good enough experience and understanding, you can, convert that experience into a mechanical process which we call as a trade plan. So to overcome this challenge, what I've done is I have created a document for you. In fact, not one document, I've created two documents for you. The first one is the trade plan steps, which is basically a flow chart that guides us what we need to do as a demand and supply trader step by step. Now, every step has its own elaborate rules, and those rules can be found in the rule book. Now, again, I'll add that this rule book is a conservative approach. With time, with experience, you can definitely make it, make it more in sync with your personality style. If you want to make it more conservative, you can make it more conservative. You want to make it aggressive, you can do that. So at least you do have a starting point with you, using which you can start planning your trades very mechanically rule based. And eventually, uh, as you gain more and more experience, you can make some modifications to it, because like I always say, there is no one size that fits all, right? Every trader has different needs, different personality styles, different reasons to trade. In fact, even trading different markets. So yes, you can make modifications to it as you gain more and more experience. So what is our step number one when we start planning our trade? Our step one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, it can also be the stop loss, any kind of exit. So do not assume by target I only mean profit, right? Exit can be any exit. It can be profit, it can be break even, it can be loss, right? Any kind of exit. So why are we starting with the trade purpose as a step number one? The reason for that is when we do our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available to me. So out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because logically The longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So that's the logic we follow. Longer durations, bigger time frames; smaller duration, smaller time frames. So what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income means a trade which can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I definitely said that daily income is a trade which can last for a day or few days. But I'm pretty sure all of you would have experienced that when you're trading markets which are not 24 hours market, whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is you can get profit, which is bigger than what you were expecting on that trade. But if you have a gap against you, you can also lose more than what you are willing to lose on that trade. And that is why my recommendation to all of you would be that initially your hourly dailies should be done strictly as intraday trades, because we don't want to take that unnecessary overnight gap risk. Because when you're starting with the new methodology, you are lacking experience, you can make mistakes, and those mistakes can be very costly if the gaps are against you. So we don't want to be in that spot. So initially, as a risk management rule, hourly dailies are strictly intraday trades. For weekly monthlies, anyhow, we're not expecting to get the exit the same day. So here we have no choice, but we'll have to keep these positions as overnight trades. But that does not imply that for weekly monthlies, you cannot have gap against you. It can still happen, but the probability reduces because we are leaning against some bigger time frames. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight trades, that's perfectly fine. Nothing wrong with that. It's just that initially, as a risk management rule, we are trying to avoid that. So my step one is I need to choose my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So I go to page number 28 on the rule book. We start with the topic multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of four different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Now, every time frame is used for a specific purpose. Higher time frame is used for demand supply curve analysis, intermediate for trend. On the lower time frame, we identify areas of demand and supplies for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the four different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my four different time frames? And we get the answer from this table. Like in this example, I opted I want to plan monthly income trades. So my time frames as a monthly income trader will be monthly, weekly, daily, and 60. Monthly will be the higher time frame used for curve analysis. Weekly will be the intermediate used for trend analysis. Lower time frame will be daily. That is where we get our ACTS from. ACTS stands for stop loss entry target and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules. That is also where this time frame can help us. Now mind it, this table is for the NSE market, because this market is open for a very short duration, about 6 hours and 15 minutes. But when you're trading markets which are open for longer durations like commodities, forex, then I have another table on page number 32. So this is the one you can refer to if your markets are open for longer durations. But since we are taking example from NSE, we'll be looking into this table because, like I said, this market is open for a very short duration, which is just about 6 hours and 15 minutes. All right, so coming back to uh, our step number one, I opted I want to plan monthly income trades. As soon as I selected my purpose of trade, now I have the clarity to what time frames I'll be using. Plus, I also have the clarity to what analysis I'll be doing on each and every time frame. So challenge number one taken care. The next challenge now is, yes, I do know my time frames, but if we take the again example of NSE, we have over 2000 companies listed on NSE. So humanly not possible that I sit and analyze 2000 stocks every day. So what I need to do now is I need to have a process in place for selecting scripts, that out of these 2000 companies, I need to select a smaller list, because if I have a smaller list, I can do my analysis almost every other day. But if I have to go through 2000 companies every day, I'm pretty sure nobody would want to do that. So how do we get that small list? For this, we use certain computer programs which are called as scanners or screeners. Now, very, very important, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, they can never be blindly bought or sold. So remember, the job of the scanner is never to tell you what you need to buy or what you need to sell. The job of the scanner is from a bigger list, help you get a smaller list so that you can analyze these symbols one by one, match it with your trade plan. If any one of these match with your trade plan, they might be your opportunities. If they don't match, you simply skip them. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created a scanner for you, which is based on some moving averages. And based on that, it is helping us shortlist some symbols. Second example, on my YouTube channel, if you search for scanner, you will be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll also be able to find a video on top-down analysis, which can help you in shortlisting symbols. So let's look at few examples before we move ahead so that you have the understanding how you can get a smaller list for you. So like I was talking about, that once you go to our website, under the free tab, you have the option for stock screener. Because I opted, I want to plan MIT trades, I can click on MIT, I can run the long scan and the short scan. So here you can see the long scan is shortlisting three symbols for me, but like I already said, just because these three symbols are getting shortlisted does not mean I can blindly buy these three. Similarly, if I go to the short scan, you can see in the short scan we don't have any results. So this can happen at times. Maybe none of these symbols are matching with these conditions that I've given in the scanner. So this is what the job of the scanner is, to give you a smaller list. And can you see, out of 2000 plus companies, I just got a list of three symbols. So what I need to do now is I can analyze these three. If any of these three they match with my trade plan, they can be my opportunities. If nothing matches with my trade plan, I don't have any opportunity available as of today. Now, many times what can happen is your list can be a very small list, like you can see today, or maybe at times it might not even filter anything because maybe nothing is matching with these conditions. Or even otherwise, if you want that my list should always be a little bigger so that I can go through more number of symbols to identify my opportunities, then you can see that in this scanner, I have given 5 different conditions. You will disable the third one. You'll run the scan again, and I'll do exactly the same thing for the short scan. Oops, just give me a second. Right, so we'll also do the same thing for the short scan and run it again. And now you can see that initially it was giving me around three symbols, but now I have 61 from here. And if I go to the short scan, I have 27. So we have 61 plus 27, which is 88 symbols to look into. So it's not that after, changing this condition, I got maybe 500 or 600. It's still a very small list, just about 88 symbols to analyze, which I'll say can be easily done in about half an hour, 45 minutes. But if you feel that this list is still bigger and you further want to filter it out, then you can apply different filters. Example, I can say, I don't want from the cash segment. I only want the ones which also get traded in futures. I'll run the scan again. Here also I'll do futures. I'll run the scan again. And now you can see I have 15 plus how many? 15 plus 12, which is 27 symbols to look into. So you can see that by using different filters, different conditions, you can make your list bigger, you can make your list smaller. And this is not the only screener which is available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you. Some of them are based on fundamental analysis. Then you have your top loved. Then you have based on candlestick patterns. If I go down, you can see you have range breakouts, you have bullish scans, you have your bearish scans. Then you have your intraday bearish, intraday bullish crossovers. So you have n number of scanner screeners available to you. And this is just one website. If you do a Google search, you'll be able to find n number of websites, n number of scanner screeners. Whatever you feel is the right fit for you is the one you can use. Now, coming back to our steps. Right, so our step number 2 was to select scripts, and here you saw that we got a list of about 88 symbols to analyze. Now when you start analyzing them, there are again few challenges which you will face. Let's also touch upon them. So the very first challenge which you will face is that, just give me a second, is what you'll realize is that when you're analyzing these symbols, most of these symbols, they don't have a quality demand zone or a quality supply zone on the lower time frame, which means you're wasting a lot of time analyzing such symbols where nothing quality is available. And the second challenge is that few of these symbols which might have quality zones, those zones might be really far away from the current market price due to which you might have a longer waiting period before the prices are back. And during that waiting period, whatever price action develops, it might even disqualify the trade setup for you. So these are some challenges we face when we are using scanner screeners, which are based on either conventional technical analysis or fundamental analysis. And to overcome these challenges, I've also created two custom built tools. One is called as the alert service. The other one is the demand supply screener. Again, I'll add these are not call giving or tip giving services. These are also scanner screeners. The only difference is that these scanner screeners are based on demand supply zones. Now, just to help you understand them a little bit, now if you want to have more information, you will be able to find the link to the walkthrough videos in the description. You can go through the walkthrough videos to understand them better. But just as a example, I'll quickly explain to you what these two are. So what alerts basically does is that as soon as you have a formation of a demand area or a supply area, it immediately notifies you. For alerts, we do have demo channel available. We have the demo channel for NSC, we have demo channel for Forex, we have demo channel for MCX. And here you can see for the NSC, we provide you alerts for half an hour during the trading day. So these are the alerts for the 24th of May. And you can see we provide these alerts from 11:15 to 11:30, sorry, 11:45, right, which is for about half an hour. And here you can see as and when these zones are getting formed, you get these real-time notifications that on which symbol, which time frame you have a formation of a demand area or a supply area. Like here you can see it's telling you on page India, we have a rally-based rally zone on the 5 minutes chart. That's the proximal value, that's the distal value. So as and when the zones are getting formed, you immediately get notified. Now once you get these notifications, you can't trade them blindly. It is just helping you shortlist where zones are getting formed during the live market. Now that you know where these zones are getting formed, you will have to qualify these zones based on your trade plan. If they qualify, they can be your trading opportunities. If they don't qualify, you simply skip them. So here you can see you have your for 5 minutes. Then you have on the daily time frame. These are the alerts for daily time frame for 15 minutes. Then again, you can see at 11:20 we have for 5 minutes. So this is what the alerts they basically do, that as and when the zones are getting formed, they immediately notify you. And this is how it takes care of these two challenges, because of challenge number one was that there are no quality areas here. Based on the formation of the zones, it is only shortlisting for quality areas. And since you get notified as soon as the zone is formed, your current market price will always be close to the zone. So that's your alerts. But the thing you have to remember is that alerts are only based on the zones which are getting formed on that particular day, right, during the live market. What has already happened in the past, it is not taking that into consideration. But yes, definitely on that particular day, it would have given you the alerts. But alerts always work on the basis of what is happening as of today. Now we also have another tool which is called as demand supply screener. Now what screener basically does is we input a list of symbols into the screener. So like here you can see I've given the screener a list of about 40 symbols, and then I've set my settings as that out of these 40 symbols, on whichever symbol my current candle is within 1% proximity to a demand area or a supply area, shortlist that for me. So now you can see that I don't have to analyze these 40 symbols. It is telling me, okay, these are the 40 symbols you have given me. Out of these 40 symbols, Infi is close to demand and Ultratech Cement is close to supply. So I don't have to waste my time analyzing such symbols where the price might be really far away. So can you see that saves me a lot of time? And here I've only applied it to one chart. Similarly, you can apply it to n number of charts, and you can have it n number of symbols to shortlist from. And just as an example, if I go to Infi, you will see that on Infi, we will be close to a demand area. That is why it got shortlisted for us. So let's just give the indicate a few seconds to load. Here you can see I'm closer to the demand area. That is why it got shortlisted for me. And if I go to Ultra Tech Cement, you will see that I'll be closer to a supply area, and that is why it is getting shortlisted for me. So here you can see we do have a supply zone, and we are pretty close to that supply zone. So this is what the screener does. So screener is shortlisting based on the proximity of the current candle to a demand area or a supply area. Now that demand supply area can be from today, it can be from the previous week, from the previous month, from the previous year, from the previous decade. Doesn't make any difference as long as the current candle is within that range. So these are the two tools which are based on demand supply zones. Again, I'll add step two is to get a smaller list. I just showed you a number of tools that are available to you, over 150,000 tools which are based on conventional technical analysis and fundamental analysis, that too based on just one website, and two tools which are purely based on demand supply zones. Again, I'll add, these are not call giving or tip giving services. These are scanner screeners. And this process of getting a smaller list can also be as simple as, I don't want to use any of these scanner screeners. I want a small list. So I'll only be analyzing my Nifty 50 stocks. Or maybe I have my own favorite list of stocks which I want to analyze. So choice is yours how you want to get that small list. I just showed you a number of ways that are available to you. So whatever list you get, what we need to do is next, we need to analyze all these symbols one by one. Whatever is in sync with your trade plan, that's your opportunity. Whatever doesn't qualify based on your trade plan, you simply skip it. So what are we supposed to do next? We'll move on to step number 3, because from step 1 we got to know our time frames. From step 2 we got to know what symbols I'll be analyzing. So we'll take the very first one. We'll go to the lower time frame. So question is, what is my lower time frame? We had the answer from our step number 1, that as a monthly income trader, my lower time frame will be daily. So let's assume that this was the very first symbol which was shortlisted for us. So I'm on the daily time frame. Let me disable the demand supply zone indicator for now. Now, whenever we talk about demand supply methodology, I always say it's a price action based methodology. Price action based methodology. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only two things. Price can either move up or move down. It cannot do anything else. But when price moves in a narrow range, we call it as the period of pause, or we can also call it as our basing. Now, initially, when we start learning demand supply methodology, our eyes are not trained to identify these structures. So that is the time to start training our eyes. We follow a mechanical process which is called as boring exciting candles. Again, I'll add, this is initially when your eyes are not trained, because you will see most of the zones can be identified based on boring exciting technique. Again, I'm saying most of the zones, I'm not saying every zone. But as you start having more and more experience, what you'll do is, as your eyes, they start getting trained to identify these structures, from boring exciting, you'll start shifting towards what is price action showing me. Now, if I talk about price action is simply understanding the movement of the price. So here you can see below the current market price, I can see we came down, we paused for a while, we started moving up, and that is what we can call as a drop based rally structure. So can you see, once your eyes are trained, you will be able to identify these structures without using any of these indicators. But the indicators definitely can make your life easier and faster. Now, I have created two indicators. One is called as the boring candle indicator. It's an absolutely free indicator. You can use it for free forever. Similarly, I've also created another indicator called as the explosive move indicator, which helps us identify the explosive moves on the chart. And this is also a 100% free indicator. You can use it for free forever. So you can see when I apply both these indicators, it is telling me this is where we have an explosive move. Next to it, we have our basing candles, because these are all in blue color. And next to it, we have an exciting candle. Now, the exciting candle to the left of the basing is your leg in, and the exciting candle to the right of your basing is your leg out, which in this case is also an explosive candle. So you can see that irrespective whether I was using price action or whether I was using boring exciting technique, I have been able to identify this structure in both the cases. Now, the next indicator we also have is called as the demand supply zone indicator, which is more like GPS, that I don't have to identify the zones now. I just apply the indicator on the chart, and it automatically identifies the demand and supply areas for me and also plots those zones for us. And you can see it is also identifying exactly the same zone for us, which is a drop based rally. So irrespective whether I was using price action or boring exciting technique or the demand supply zone indicator, we are able to identify the same zone in all the three cases. Now, today's example you'll see is a very beautiful example, because we'll have quite a few things to learn from this one. So let's start with the very first learning. So I have identified the zone. Let's mark the zone. So the zone is now available on the chart. In fact, I don't have to identify it. The indicator automatically did for me. So identify zone. Do we have a zone available? The answer is yes. Now, this is where demand supply traders, they make the biggest mistake. And that biggest mistake is they find any demand area on the chart, blindly start buying. They find any supply area on the chart, blindly start selling, which is incorrect. You can never blindly buy or sell at any demand area or any supply area. Once your demand or supply zone has been identified, The next step is to qualify it. And for qualification, we have a two-step process. In step one, we'll qualify it based on certain conditions. And in step two, we'll qualify it based on the booster scoring. So the first thing we'll check is that the zone we have identified, does it qualify as a case of level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone on the lower time frame divides into multiple zones, we call it as a case of level on top of level. So what we understand here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate time frame zone, which we call as a coinciding level. Now, this is where we'll have our very first learning. Now, if I look at the same zone on the weekly time frame, you will see that this zone is definitely inside of a weekly area. So you can see this is where we have a drop based rally, which is my weekly zone. Let's mark this and mark it with a different color. So yes, most of you will say, yes, we can call it as a coinciding level. But remember, when I was talking about how do we check cases of level on top of level, I said when you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones, right? And if the same zone is dividing into multiple zones, that is what a coinciding level is, right? That the same zone should also be part of my intermediate time frame zone. But here you can see my intermediate time frame zone is coming from different candles and this zone is coming from different candles. So my zone of the intermediate time frame and my zone of the lower time frame are not exactly the same. So this is basically a reaction to the zone. So even though yes, the lower time frame zone is inside, it is not a coinciding level. Coinciding means that both the zones should be common on the lower time frame as well as on the intermediate time frame. Here intermediate time frame zone is a different zone and the lower time frame zone is a different zone. So that does not make it as a coinciding level. So very, very important. In fact, I'll say, this is our 20th session for the year 2024, and that's the very first example where probably you would have got more clarity to what to refer as a coinciding level and what not to refer as a coinciding level. And this is why I always keep saying that every session will have something new to learn from. But yes, once you have gone through probably 100, 125 or maybe 150 sessions, then you might not have something new to learn, right? But at least I'll say 50, 60 sessions, you might have something new to learn from every other session, because whenever we are looking at markets, markets are throwing at us a lot of different scenarios which cannot be covered in one single session. So that is why, again, I highly recommend you people to be regular with these sessions. If you can join live, perfect. If you can't join live, at least later watch the recordings so that you can understand all these concepts. So yes, even though we are inside of it, it is not a coinciding level. So now that we know it's not a coinciding level, we can move on to the next condition which we need to check, that is this zone because of a gap. This zone is not because of a gap, therefore will not apply the gap rules. And coming to pivot and non-authenticity, now this is definitely a drop based rally, and to qualify a drop based rally we have two approaches. The aggressive rule says the move from the zone should have violated one opposing zone on the intermediate time frame, which has not happened. So going with the aggressive rule, this disqualifies. And going with the conservative rule, we need to have an explosive move. That is one of the, not explosive, we need to have an impulsive move, which is one of the condition, and we don't even have an impulsive move here. So irrespective whether you are applying the conservative rule or the aggressive rule, this will not qualify. And that is why I was saying, just because you see a demand zone on the chart does not mean you can blindly buy on that demand area, because now this demand area based on our rules got disqualified. So we cannot use this. So what do we do next? Since we cannot use this, we'll check, do we have any other zone available on the chart? And the answer is yes. You can see here we do have a rally based rally structure. So now let's shift to this area. So again, a beautiful example where even though we had a zone, we are not using it because it does not qualify based on our trade plan. So now we have moved on to the next one, which is this rally based rally. Now again, we'll check these conditions. The first one will be, is it a case of level on top of level? Now in this case, you can see that yes, my zone is exactly where the intermediate time frame zone was, right? So it's part of that intermediate time frame zone, and that is what we call as a coinciding level. So again, a very beautiful contrast between the two, a zone which is not a coinciding level and a zone which is definitely a coinciding level. So this is definitely coinciding. And do we have multiple zones on the lower time frame? Now when we talk about level on top of level, the other areas might not be quality areas. So we'll check mark all demand supply zone structures, and here you can see that I do have. Let's zoom in to understand this better. So here you can see I do have my intermediate time frame zone, which is getting divided into multiple zones on the lower time frame. And since the intermediate time frame zone is dividing into multiple zones on the lower time frame, we'll call it as a case of level on top of level. And what we should be doing in this case, we should be going for the lowest zone, which is this one. That is what we should be doing. And because it was also a coinciding level, I would prefer to have my stop loss from the intermediate time frame distal, not from the lower time frame. Now, is it mandatory to make that modification? The answer is no, but I always prefer to do that. So I have taken my distal line from the intermediate zone, and let's draw our 1:1s, 2:1s, and 3:1s. Just give me a second. Let's do that. Entry, back to the stop, back to the entry, and now we have our zone. Oops. Just give me a second. Created that. So yes, we started with the very first zone, which got disqualified. Then we moved on to the next one, which proved to be a case of level on top of level, due to which we also had to shift to the next level. So going back to our flowchart, it was a case of level on top of level. Whatever modification was required, we have made those modifications. It is not because of a gap, therefore we need not apply the gap rules. Now it is a case of level on top of level, so even if it is a pivot or an authentic zone, we can bypass this rule, and the same thing applies to unstable equilibrium. And I can show you this in the rule book. There in the rule book, it clearly states that in case of level on top of level, we already have that extra probability we are looking for. There is no need to apply the pivot or non-authentic rules for the cases of level on top of level, because by default that probability is stacked in our favor. All right, so yes, now none of these conditions, they disqualified the zone for us, so we are ready to move ahead with our booster scoring. So talking about the booster scoring, again you will see we have something new to learn from here. Now the very first one is freshness, and here you can see if I bring back my options that I want all zones, that the lower zone has already been tested by the upper zone, but it's a very shallow touch, and for a shallow touch we can give it a score of 1.5. Next, if you talk about strength, we don't have an explosive move, because if this was an explosive move, the indicator would have marked it for us. So it's not an explosive move, so I can't give it a score of 2. We don't even have a follow through pattern, therefore I'll have to give it a score of 0. But now, okay, let's first do the other two, and then we'll talk about something more. Time at the zone, we only have how many candles in the basing? Let's verify. Do we have 2 or do we have 1? So we have just 1 candle in the basing, and 1 candle in the basing again gets a score of 2. Reward to risk ratio will be taking as an assumption. Now, just a second. If I go back to the rule book, you will see in the rule book I have given you certain characteristics for cases of level on top of level, and these characteristics will not be applicable to every case, but many times you will see these characteristics. At times one of them might be applicable, at times 2 of them might be applicable, at times all 3 might be applicable, at times maybe none of these might be applicable. So the characteristic says that in case of demand, the lower zone might be tested by the upper zone. That is what we saw in this case, right? Similarly, in case of demand, the lower zone might be lesser strength versus the upper zone. We also saw that, due to which we gave it a score of 0. And in case of demand, the lower zone might also have more number of candles versus the upper zone. So at times what can happen is maybe the upper zone has just 2 candles, the lower one might have 6 candles, maybe even 7 candles. So this can happen. But what you need to remember is that level on top of level basically implies that you are trading the intermediate time frame zone by fine tuning it on the lower time frame. So what are we doing here is, if you think about it technically, I am basically trading this intermediate time frame zone, which we will mark with a different color. I'm basically trading this zone. And if you think about it, if I wanted to trade this zone as a wick to wick method, then my proximal line would be here, my distal line would be here. That will make the zone pretty wide. If I go to body to wick method, still my proximal line would be here, but because I saw that the same zone is getting divided into multiple zones, I was able to fine tune my entry a little deeper into the zone. So we are basically trading the same zone. It's just that we have fine tuned it on the lower time frame. So if we see the above set characteristics, we can ignore those characteristics. Can you see? If you see the above set characteristics, they can be ignored, and the zone can be rated based on the intermediate time frame. So what you need to remember here is that whenever you're doing this, you're only doing this to check if any of the score can be upgraded, never for a downgrade. So freshness was 1.5. Here also see that the zone has been tested, so we cannot upgrade this. The zone is not fresh. But if you talk about the strength here, if I change this that I don't want automatic settings and I only want quality zones, then you can see that based on quality zones, this zone is getting identified for me. So now I know for a fact that this is a quality zone. Let's check whether it is an explosive candle. So it's not an explosive candle, but we do have a good move. So a good move can definitely get a score of 1. So this can be upgraded to a score of 1. Rest of them were already having the highest score, so I will not be making any modifications to it. Next is what is the location. If I go to my monthly time frame, you can see that we are also planning this trade at the best location, which is the monthly zone, and the best location always gets a score of 2. Now at best location, trend becomes irrelevant. It doesn't matter whether it is up, down or sideways. It can be traded with a score of 1. Move from the zone, we need minimum 4:1, which has already happened. You can see we have been pretty far away from the zone before it started coming back. Gets a score of 2 again. It is a case of level on top of level. It is also coinciding, but for trap, I'll give it 0, because you will see that if I take a horizontal line and start pushing it up, trying to find an area where prices have been bouncing over and over again. So maybe, I can call this area has acted like support in the recent past. But if I go further back, you can see prices have been just whipsawing through this area without a lot of bounces, right? We do have few bounces, but that does not make it as a very clean area of support and resistance. So that possibility of this working like a trap is definitely a little low, because we don't have a very clean support area resistance. But still, if you look at the overall setup, it's a medium quality setup with high probability, which makes it as a type 1 trade for us. So yes, after applying the boosters, we got to know that this can be done as a type 1 trade. Now, no matter how high the quality or how high the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario and do a proper position size calculation. Now, whenever the prices are back, we'll have to re-verify, because markets are not static. Markets are dynamic. Conditions are changing almost every other second. So before entering into a trade, we need to re-verify, does it still qualify based on my trade plan? If the answer is yes, we'll place our order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it as a break even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based. And today's example was a very beautiful example to understand what do we mean by coinciding level, how zones can get disqualified. Then we also saw what are the characteristics of cases of level on top of level, and how much weightage do we have to give them, and what are the way arounds when we see certain conditions. So a very beautiful example is what we have for today's session. Now that we are done with the analysis, or I'll say the example for today's session, let's get into the questions I have in the chat box. But before I do that, I'll definitely add that if you people are liking these sessions, do ensure you hit the like button. And if you're not subscribed to my channel, also ensure you subscribe to it, so that you get notified whenever I plan these sessions. Now generally I plan this session every Sunday, 10 p.m. Indian Standard Time. But at times, if I'm not available, the timings will be changed, and the only way to get updated for that is if you're subscribed to the channel. You'll get notified whenever we are scheduling these sessions. And of course, I'll add, if you are into some trading groups, or if you have any friends or family members who are into trading, you can definitely share my course with them. You can also share these videos with them. That might help someone. So let's see what we have in the chat box. So the first one is, I want to join your live sessions. So yes, you can definitely join these live sessions. They are not paid sessions. These are absolutely free sessions. Anyone can join. It's just that whenever the live session is happening, do ensure that you are available, and you can definitely join into that live session almost every weekend. All right, let's see what do we have next. Hi Surjit, what's your thought on explosive candles or leg outs that created during news events? Okay, so that's a very interesting question, D's nuts. Now, if you think about it, the methodology by default takes care of it, right? How it takes care of it, now let's try to understand it with a very simple example. So see, this is what we do. We have our very high of the curve, we have our very low of the curve, right? So that's your high time frame demand areas and supply areas. Now let's assume that the prices have already come, maybe very low of the curve, and that is where we have been basing for quite a while. And then we have a news event. Now let's take example of, good news, right? So let's say there is a good news and prices immediately start moving up. Now this could be the catalyst which can now convert this downtrend into an uptrend, and prices can keep moving unless and until we hit this supply. So this is a demand area which was formed due to some news, and I won't mind trading that area if the prices are backward, because I know overall my location is a very good location to participate. But if I have the same thing happening the other way around, so what do I mean by that? Let's remove some of these. Let's assume that the prices have already moved up really far away, and now we have some positive news due to which again prices they start moving up like crazy. Now, when I do my multiple time frame analysis, this will tell me that even though we have a formation of a demand area, this is not the right time for me to be a buyer. So can you see whether that zone got formed because of news or not because of news? The location is something that will help me understand when to participate and when not to participate in such areas. So I guess that helps you with the answer to that query. Okay, so there is a challenge by mistake. I closed my uh, chart window, so now I'll not be able to get back to the charts. But anyways, I can take your queries without the charts as well. All right. So, did you use a buffer for your entries? Example: 10% of daily ATR for added buffer zone, or 20%. See, I don't use that 10% of ATR because what is going to happen is again I'll have to do the calculation and do it. But if you go to my website and you will see that under free tab, I have a link to the video which is called as trading analysis, where I have given you the settings for my tools, where by default it takes care of giving a little buffer that your entry is always a little above in case of demand, stop loss is always a little below, but it is not getting calculated based on ATR. So I've just given it some percentage, so just go through that video. That will help you understand how I'm giving that buffer. But I'm not using the ATR because what is going to happen in case of ATR, I'll have to again do the calculation and manually adjust it. So I try to avoid those manual hassle. So I've just built it into the Fibonacci extension tool so that it gives that buffer by default, so that we have that a little wiggle room for the entries and the stop losses. All right. Uh, so can you explain about checking leg out on the refining time frame? All right. So I think this is what you are basically pointing at. Now, just to help you understand, so let's assume we have a drop, base, and a rally. Let's assume we have a drop base rally, and this is on my lower time frame. Now, when I look at the refining time frame, when I'm looking at the refining time frame, this leg out can be something like this, which is we have a really nice strong move, and then probably we have some maybe small moves, and that basically form this complete candle. So just as an example, if this is my 15 minutes, these will be my 3 5 minutes candle, right? These 3 5 minute candle will look exactly like this on the 15 minutes. And it can also be the other way around, right? The other way around, it can be something like this, that on the refining time frame. So this is my one example of RTF. The second example of RTF can be that initially the move was not a very strong move. We started very small. Maybe again we started very small, and then we had a big move. Now what is going to happen? These are also 5 minutes candle, and these are also 5 minutes candle, but both these scenarios on the 15 minutes will look exactly like this candle. So this is where, if you want to further understand what kind of scoring I should be giving to my zone for the strength, we can, it's more like we are now looking at it under a microscope to understand how the strength was. So a very strong initiation of the move is always better, and not a very strong initiation of the move, but later you're seeing that strength building up, is not something which is very good for us. So this is an example how your refining time frame can help you in understanding better how the strength was. So probably that is what your query was. This question was from these nuts, right? So I think that basically helps you understand how the refining time frame can help you in understanding the strength factor. Which script you are explaining? So Sandeep, I don't disclose the name of the symbol, and the reason for that is, there are two reasons. So let's talk about the very first reason. Very first reason is I have people joining from all across the world. Some people might be trading stocks, some might be trading commodities, some might be trading crypto, some might be trading US markets. So if I'm not disclosing the name of the script, it does not affect the analysis part, right? Because now people know the same analysis can be applied to any chart. But if we put a name of the symbol, then at times people might think, okay, this might be only be applicable to this particular symbol and not to other symbols. So to keep it as a universal kind of analysis, I don't disclose the name of the symbol. And the second reason is also that there can be some legal issues, because of which I would not like to disclose the name of the symbols, because I want to keep these sessions not as tips or recommendations. I want to keep these sessions more of educative sessions so that you understand the process, and once you understand it, you can apply to any chart you wish to, right? So those are the two reasons why I do not disclose the name of the symbols. All right. So, what buffer do you assign when you use a Fibonacci retracement to determine stop loss and targets? 5%, 10%. What do you suggest? See, it's 5%, 10% is a very big number, but yes, if you're going based on the ATR way, where you look at the ATR and then you're adding 5%, 10%, that is where it is acceptable. But if you look into this, I guess I'm just adding 0.1% or maybe 0.2%, right? That is what I keep. So again, I'll add that once you go to my website, under the free tab, there is an option which says trading analysis, and there you'll be able to find the videos where I've explained how I am keeping that buffer, and you can follow that video to understand what buffer I'm keeping. I think it is 0.2% what I keep. Shouldn't buffer be assigned depending upon the security volatility? Yes, and that is what the Fibonacci settings which I'm keeping by default takes care, because if the script is very volatile, the zones will be wider, and if the zones are wider, by default that 0.2% will become a bigger value. But if the script is not very volatile, the zones will be narrower, and by default that 0.2% will be a smaller value, right? So that is how it also takes care of that volatility when it comes to using the method which I'm using for giving that buffer. So again, the wider the zone, the bigger the buffer will be. The narrower the zone, the smaller the buffer will be. All right. Great. I like your view on and so mechanical. Hope your channel gets much follower. It's really all right. Thank you so much, these nuts. I appreciate your feedback. Let's see. Thanks for clear explanation and golden nuggets you provide on your weekly sessions. I agree. All right, great, perfect. So that brings us to the end of today's session. Thank you so much for joining in. I will be seeing you now next weekend, which again will be a practical session for us. So until then, trade safe. Enjoy your Sunday evening. Take care. Bye bye.